At exactly 8:17 on a Tuesday morning, a 56-year-old man opened his banking app and realized he had made a mistake that would cost him the rest of his life. His retirement account wasn't empty. It wasn't even close, but it wasn't enough. After working for more than 3 decades, he had reached the point where most people dream of stopping, only to discover he couldn't afford to. The painful part wasn't that he had failed. The painful part was that he had done everything society told him to do. He worked hard, he saved money, he avoided debt, and yet he was still trapped.
Now here's the question. How can someone spend 30 years doing everything right and still end up financially unprepared? The answer has almost nothing to do with how much money he earned. It has everything to do with one decision he kept postponing for years. A decision that takes less than 5 minutes to make, but can change the next 30 years of your life. So let's go back in time, 32 years earlier. His name was Michael. He was 24 years old. He had just landed his first full-time job. Nothing glamorous, just an ordinary paycheck. Like millions of people, he promised himself that once he started earning more money, he'd begin investing. After all, what difference could $100 possibly make? So he waited. 1 year became 2. 2 became 5. Every raise came with a better apartment, a newer phone, a nicer car, and more monthly expenses. His income grew, but his investments never did. Without realizing it, he wasn't building wealth. He was building a more expensive lifestyle. Across the city, another 24-year-old had almost the same life. His name was Alex. Same salary, same bills, same dreams. But there was one small difference. On the first Friday of every month, before paying for anything he didn't absolutely need, Alex invested $100. Sometimes he wished he could spend it on something fun. Sometimes he questioned whether it even mattered. $100 felt insignificant. It didn't make him feel richer. It didn't change his life overnight. But he kept doing it anyway, month after month, year after year. Now, if you asked most people which one would become wealthy, many would point to whoever eventually earned the higher salary.
That's exactly where almost everyone gets it wrong. Wealth is rarely created by income alone. Income gives you the ability to build wealth, but only investing gives your money the chance to multiply. That's the difference nobody teaches in school. Your paycheck can feed your present. Your investments can build your future. Imagine planting 2 identical seeds, one today, one 10 years from now. Which tree will be larger? The answer has nothing to do with the quality of the seed. It has everything to do with time. Investing follows the same law. Time is the one asset that multiplies every dollar you invest. And unlike money, once time is gone, you can never earn it back. That's why wealthy investors treat time as their most valuable investment. Not because it's expensive, but because it's impossible to replace. So why doesn't everyone start early? Because your brain wasn't designed to think 30 years ahead.
It was designed to survive today. Psychologists call this present bias. We naturally choose rewards we can enjoy immediately over rewards we'll receive years from now. That's why buying a new phone feels exciting, booking a vacation feels exciting, ordering something online feels exciting. Investing doesn't. It doesn't give you instant pleasure. It gives you delayed freedom. And for most people, delayed freedom loses to instant gratification every single time. Think about the last thing you bought that you were excited about. Maybe it was a gadget, a pair of shoes, a game, a watch. Now ask yourself, how often do you think about it today? Probably not very often. That's because excitement fades, but assets can continue working long after the excitement of spending disappears. Wealthy people understand this better than anyone. They don't ask, what can this money buy today? They ask, what can this money become 10 years from now? That single question changes every financial decision you make. Here's the mistake that quietly destroys millions of financial futures. People believe they need more money before they start investing. But money isn't what they're missing. They're missing the habit. Because when someone who never learned to invest suddenly starts earning twice as much, they rarely build twice the wealth. More often, they simply double their lifestyle. Bigger income, bigger house.
Bigger car, bigger payments. Their financial stress grows right alongside their salary.
Money doesn't solve bad financial habits. It amplifies them. And that's exactly why $100 matters. Not because $100 will make you rich. It won't. It matters because it changes who you are. The first time you invest, something shifts in your mind. You stop seeing yourself as someone who only earns money. You become someone who owns assets. And once your identity changes, your habits begin to change with it. That's where real wealth begins. Not in your portfolio, but in your mindset.
But now we arrive at the biggest question of all. If you only have $100, where should you actually invest it? Should you buy individual stocks? Should you buy cryptocurrency, gold, real estate? Or is there a strategy that quietly created more millionaires than all the flashy investments combined? Before you make your first investment, there's one principle you must understand. Ignore it, and even $1 million won't be enough. Understand it, and your first $100 could become the beginning of something far greater. Before you choose where to invest your first $100, you need to understand something that almost every beginner gets wrong. Most people believe investing is about finding the next Apple, the next Amazon, or the next Bitcoin before everyone else. That's what social media sells: overnight success, hidden opportunities, secret investments. But history tells a completely different story. Most fortunes weren't built by predicting the future. They were built by consistently participating in it. Let's go back to Alex. Every month, he invested his $100 without asking himself 1,000 questions. He wasn't trying to become rich by next summer. He wasn't refreshing his portfolio every hour. He wasn't searching YouTube for videos titled, "The Next Stock That Will 100x."
He simply followed one rule: never interrupt the process. Because he understood something most people never realize. Your portfolio grows much faster when your emotions stay out of it. Meanwhile, Michael finally decided to start investing. But by now, he had a different problem: fear. Every headline made him hesitate. When the market reached new highs, he thought, it's too expensive. When the market dropped, he thought, what if it falls even more? So he waited. Then he waited again. Months became years. Ironically, he wasn't losing money by investing. He was losing opportunities by doing nothing. This is one of the strangest truths about investing. People are comfortable spending $1,000 on a new phone that will lose value the moment they open the box. But they become terrified of investing $100 into assets that have the potential to grow over many years. The problem isn't mathematics, it's psychology. Humans naturally fear temporary losses more than they value long-term gains. That's why successful investing is less about mastering the market and more about mastering yourself. Now imagine you're standing in front of two doors. Behind the first door is excitement, fast profits, viral success stories, people claiming they turned a few $100s into millions overnight. Behind the second door is something much less exciting: consistency, patience, years of quiet investing. Which door do you think most people choose? The first one, because excitement is addictive. But here's the irony: the second door is the one that has quietly created far more long-term wealth.
This doesn't mean every investment will succeed. Markets rise, markets fall. Companies grow, others disappear. That's why experienced investors don't rely on a single company to build their future. Instead, many choose diversified investments that spread risk across many businesses rather than depending on one winner. Think of it like building a ship. You wouldn't trust your entire journey to a single wooden plank. You build something strong enough to survive storms. Diversification works the same way. It doesn't guarantee success, but it can reduce the damage when one part of your portfolio performs poorly. Here's another lesson Alex learned early: never confuse activity with progress. Michael checked financial news every morning. Every market movement changed his mood. Green numbers made him optimistic. Red numbers made him panic. Alex looked at his investments only when it was necessary.
He spent the rest of his time improving his career, increasing his income, and continuing to invest. One was obsessed with prices. The other was focused on building assets. Years later, those two habits produced completely different lives. Now let's talk about a silent enemy almost nobody notices: lifestyle inflation. Imagine getting your first promotion. Your salary increases by $500 every month. What happens next? For many people, that extra money disappears almost immediately. A nicer apartment, a luxury car, more subscriptions, more expensive restaurants. Every raise improves their lifestyle, but never their future. They earn more than ever, yet they still feel financially stuck. That's because increasing income without increasing investments is like pouring more water into a bucket full of holes. No matter how much you add, it never stays full. Alex followed a different rule. Every time his salary increased, he increased the amount he invested before changing anything else. He rewarded his future first and his lifestyle second. It wasn't always easy. Sometimes he wanted the same things everyone else wanted, but he understood something most people don't discover until it's too late. Luxury can wait. Time can't. Every year you delay investing is a year you'll never get back. By the time both men reached their 40s, the difference between them wasn't visible from the outside. They drove similar cars, they lived in similar neighborhoods, but financially, they were living in completely different worlds. One depended entirely on his next paycheck.
The other owned assets that continued working whether he was awake, asleep, or on vacation. That's the real definition of wealth. Not expensive possessions, but financial independence. So now the question isn't whether investing works. The question is whether you're willing to think differently from the crowd. Because the final lesson has nothing to do with stocks, ETFs, or money itself. It's about one habit that separates people who dream about financial freedom from those who actually achieve it. And once you understand this final principle, you'll never look at your paycheck the same way again. There's an old saying on Wall Street that goes something like this: the market is a machine that transfers money from the impatient to the patient. Whether you've heard that quote before or not, it captures one of the most important truths about investing. The people who usually succeed aren't the ones who know the most. They're the ones who quit the least. Let's go back to Michael and Alex one final time. 30 years have passed. Both worked hard, both sacrificed, both earned promotions, both experienced recessions, market crashes, inflation, and uncertainty. But their lives ended in two completely different places. Michael spent 3 decades exchanging his time for money. Every month started at zero. If he stopped working, the income stopped too. Alex built something different. Little by little, he bought pieces of businesses instead of only buying things. While he was working, his investments were working too. Eventually, his money began producing more money than he could save on his own. That wasn't luck. It wasn't genius. It was the result of one small decision repeated hundreds of times. This is where most people misunderstand wealth. They think becoming wealthy means earning more, but earning more only increases your potential. Investing is what transforms that potential into reality. Imagine filling a bucket with water while a hole at the bottom keeps getting bigger. No matter how much water you pour in, it never stays full. That's what happens when every raise goes toward a bigger lifestyle instead of bigger investments. Income can make you feel richer. Assets can make you become richer. Now, let's answer the question you came here for.
If you have only $100, what should you actually do? First, build the habit before chasing returns. If you can't consistently invest $100, you probably won't consistently invest $1,000. The habit always comes before the amount. Second, avoid trying to predict the next big winner. Instead, build a diversified portfolio that matches your long-term goals and your tolerance for risk. Third, continue investing regularly, even when the news is negative. Markets move in cycles. Fear comes and goes, but discipline compounds. Finally, keep learning. The best investors never stop improving their understanding of money, businesses, and human psychology. Here's something most people never realize until it's too late. Your first $100 is not an investment in the market. It's an investment in yourself. It's proof that you've decided to stop living only for today's paycheck and start building tomorrow's freedom.
That's why the amount isn't the point. The identity is. Every time you invest, you're reinforcing the belief that your future deserves a place in your monthly budget. Imagine 2 versions of yourself 10 years from now. The first version keeps waiting for the perfect time. They still believe they'll start once life becomes less expensive, once work becomes less stressful, once they earn a little more. The second version started today. They weren't perfect, they didn't have unlimited money, they simply refused to let another year pass without taking action. Which version do you think will thank you? Financial freedom doesn't arrive all at once. It arrives quietly, one investment, 1 month, 1 year at a time. Most people won't notice anything different in your life during the first few years.
That's exactly why so many people quit. They mistake invisible progress for no progress. But just like a tree grows underground long before anyone sees its branches, wealth is often built long before anyone notices the results. By the time success becomes visible, the real work has already been done. So don't underestimate what $100 can represent. It won't buy your freedom overnight, but it can buy the habit that eventually leads to freedom. Every investor you admire once made a first investment. Every portfolio worth millions once started at zero. Every journey toward financial independence began with a single decision to stop waiting. One day, you'll open your banking app just like Michael did. The question is, what story will your numbers tell? Will they remind you of the years you spent waiting, or the years you allowed time to work in your favor? That decision doesn't belong to the market. It doesn't belong to the economy. It belongs to you. And the best time to make it isn't next year, it's today. If this video changed the way you think about money, subscribe to WealthVeil and join thousands of people who are learning how to build wealth one smart decision at a time. And before you leave, answer one question in the comments. If you received $100 today that you had to invest, where would you put it and why? I read every comment, and your answer could help someone else take their first step. And don't stop here. Click on the next video, The 7 Income Streams of Millionaires.
Because investing is only one piece of the puzzle. Once you understand how wealthy people combine investing with multiple income streams, you'll see the complete system behind long-term wealth. I'll see you in the next video.